G'day guys, welcome back to the Devon Too Good investing channel. In this video today, we're going to be doing a intrinsic valuation of Alphabet stock, or as some of you probably call it, Google stock. And we're going to be using the discounted free cash flow method to calculate its intrinsic value and try to work out what I might be comfortable paying for this stock. And of course, this is not going to be financial advice, and any assumptions in this video should be taken as just assumptions, and you should do your own research. But anyway guys, before we get into it, make sure you like this video and subscribe to my channel. So when it comes to the discounted free cash flow method, the first thing we need to get is the last 12 months free cash flow, and this can be found on the cash flow statement. So what you'll do is you'll get the last 12 months cash from operations, and then you'll subtract the capital expenditures from that. And this is what I've done here, and we get about $69 billion in free cash flow, which is just an insane amount, but that's what Google did in the previous 12 months. And the next step is you need to calculate or estimate some reasonable growth rates that you think Google can grow at over the next 5 years. And honestly, this takes a lot of research and you need to do your own work into the company, but the growth rates that I've used here are 10%, 12%, 14%, 16%, and 18%. So I do think Google will probably grow in this range over the next 5 years. And I've got some evidence to try to back that up. So if we look here, we can see these are analyst estimates going out over the next 5 years, and they're estimating a revenue growth of 13.4% per year. And if we look down, we can see that for free cash flow, they're estimating a CAGR of 16.7% per year. And this isn't based off just one analyst. This is based off many analysts, and let me just pull it up and I'll show you exactly how many analysts have given some estimates. So if you can see here the amount of analysts that are analyzing Google, and you can see that currently there's over 50 of them. So there's plenty of analysts analyzing the stock, and their consensus is that revenue should grow 13.4% over the next 5 years per year, and free cash flow should grow around 16% per year moving forward. So if we jump back to our valuation model here, you can see that we also need to determine a terminal multiple. So this is the free cash flow multiple that Google will trade at in 2026 or 5 years from now. And I've selected 20. So some of you might argue this is conservative. Yeah, it probably is conservative. However, being conservative with these models is always better than being over conservative. But if we jump over back to ticker, we can see that we've got the historical price. Well, this is actually enterprise value to free cash flow multiple. And you can see that it's gone as low as about 19, and as a mean value, it averages about 36, and currently we're sitting at 28. So 20 is about as low as it's ever been. Perhaps if you wanted to be a bit more aggressive, you could use 25 here, and I probably couldn't get too mad about that. And of course, you got to make your own numbers here. But I think 20, maybe 25 is reasonable. Now 22%, that's my discount rate. That's my required rate of return. That's the return I want to get on my investments. For you, it might be different. Maybe you want 30%. Maybe you want 15%. Maybe you're happy with 10%. Obviously, that's going to change at what price you'd want to buy Google. And then the shares outstanding. This is taken straight from their latest quarterly report, and you can find this on the income statement. And then Google also have a bunch of net cash. So this is pretty much cash and cash equivalents minus long-term debt. and they've got about $120 billion in net cash. So we want to factor that into our valuation, because when you buy the stock, you essentially get that cash, or at least your share of that cash based on how many shares you own of the company. But moving forward, we can see here that based on these estimates, or these growth rates, and the terminal multiple of 20 and our discount rate of 22%, you can see that we're getting buy prices of between $1,572 all the way up to $2,082, and you could call it the base case, you're looking at $1,810 per share. So if it ever got down to $1,800 per share, for me personally, I'm not saying you should do it, but this would be a load the boat price for me. Google is a fantastic business, strong moat, operates in a duopoly essentially when it comes to online advertising, and it's just a beast company, great balance sheet, effective management team. They're always reinvesting back into their business efficiently. I also can imagine that if they wanted to initiate a big share buyback program, they could do that if they chose to. So overall, it's just a beast of a company. But we're trading at $2,451 per share at the moment, so it would have to drop a fair bit. So let's say you were wanting to be a little bit more, aggressive. If we changed the terminal multiple to 25, that would land you at a base case price of $2,100, and pretty much $2,100. That's still a little bit below where we're at the moment. Of course, Google rallied a little bit over last day, but I mean, who cares about daily movements? We're in this for the long term, right? Let's drop the discount rate. Let's see what discount rate we can get. So that lands us at our base case here. If we want an 18% return based on these factors here, if these factors were right, you could expect an 18% per year return based on the current share price. If you think 25 is too high and you'd rather use a terminal multiple of 20, you can expect about a 15% per year return, which by no means is not bad at all. 15% per year is great, and it's not often when you get such a great company with the opportunity to buy it at a discount rate of 15%. And these estimates, I don't think they're overly aggressive. I think growth is about right. I can't see him growing any slower than 10%, but I also can't really see him growing any faster than 18% per year. Terminal multiple, look, I don't think it will trade any less than 20. Of course, it's possible. Obviously, it could depend on different macro conditions out there, but I don't try to guess macro conditions. And historically, it's traded, this mean value over 5 years has been above 30. So the fact that I'm, using terminal multiples of 20 and 25, it shows that I'm not being too crazy here when I'm, doing these estimates. But anyway, guys, I hope you got value out of this video. Make sure you like it and make sure you subscribe to my channel. And honestly, I'm very interested to see what happens with Google. I honestly hope it drops more, because if it keeps falling, hey, it's a great business and I would happily add it to my portfolio. If it gets down to $1,800, I'll be loading the boat, making it a big position. Probably it would be at least a 10% position, if not maybe, I'd be willing to probably go up to 15, 20% possibly. But guys, thanks for watching and have a good one.